Hi, this is Mike Larson from Money and Markets TV. I see a lot of so-called experts on CNBC advising viewers to buy transportation, manufacturing, or technology stocks. They say it's the seasonally strong period or something equally meaningless, but they're looking at exactly the wrong indicators. They're focused solely on the stock market when it's the credit market that they should be watching. You know, the indicators I look at predicted the collapse of 2007 to 2009, and once again, they're going haywire. Before I get into the technical details though, let me explain exactly what these gauges are. First up is the Euribor-OIS spread. It measures the difference between what banks would have to pay to borrow money from each other in the Euribor market, which is the European equivalent of the LIBOR market for dollar-based loans, and what they would have to pay by entering into what's called an overnight indexed swap. Now normally those two rates track each other very closely. But when that spread blows out, it's a sign that liquidity fears are surging, that banks are afraid to lend to each other because they're worried about getting paid back. And that's exactly what's happening now. As you can see, the Euribor-OIS spread is surging to its highest level since early 2009. Another indicator I watch closely is the 2-year swap spread. Now, interest rate swaps are derivatives contracts that banks and other parties sign, and they're designed to mitigate interest rate risk. The spread tells you the difference in cost between a 2-year swap and the yield on a 2-year Treasury note. Again, in normal times, that spread is relatively narrow. But when banks get increasingly nervous about the ability of their counterparties to make good on their derivatives contracts, the cost of entering into swaps surges. It exploded higher in 2007 to 2009, and what do you know? It's rising again. In fact, the spread's widened to 34 basis points. Now that's nowhere near the 167 points we saw during the depths of the credit crisis, but it's the widest in a year, and it tells me we have much higher readings yet to come. So what's going to happen next? Well, these credit market indicators are telling me that we can expect a surge in the volatility index, or VIX. And along with that, we should get a collapse in stocks. My longer-term target on the Dow, as I told you last week, is around 7,000, a more than 4,000 point drop from where we're trading right now. Now you might argue, and argue fairly, that European and US policymakers are going to do everything they can to stop this from happening. Heck, just this week the ECB and other central banks got together to extend longer-term dollar loans to European lenders. But folks, these moves are straight out of the crisis playbook from 2007 to 2009. They simply temporarily paper over the underlying problems, ensuring that the crisis will erupt even more violently down the road. And if you're still not convinced, just look at the weak economic data that continues to pour in. Just this week alone, retail sales flatlined, with the core rate dropping to its lowest level all year. And the manufacturing sector looks even worse. Indexes from both the New York and Philadelphia Feds declined even further from already depressed levels. Bottom line, in my book, rallies are meant to be sold. Or better yet, use them to add more exposure to downside hedges and inverse ETFs, investments that rise in value when stocks fall. That's exactly what I'm doing, and if I'm right about where the market's headed, my subscribers stand to profit handsomely. I'm Mike Larson for Money and Markets TV. Thanks for watching.